Hey there, fellow investors. Welcome to another exciting journey into the world of finance. Today let's talk about making money in the stock market and how we can maximize our returns. We all want to buy low and sell high, right? It's the golden rule of investing. That means finding stocks that are going to go up in value and timing our investments perfectly. But how do we know which ones those are? It's a question that puzzles even the best of us. That's where valuation ratios come in. These ratios are our guiding stars in the vast universe of stocks. These are tools that help us understand whether a stock is overvalued or undervalued, giving us a clearer picture. Some ratios, like the price-to-earnings (PE) ratio, can be based on past performance, reflecting historical data. That's like driving a car while only looking in the rear-view mirror. It shows us where we've been, not where we're going. But here's the kicker. We don't invest to make money from the past. We need to look ahead. We invest to profit from the future, aiming to capitalize on upcoming opportunities. And that's why we need to use forward-looking ratios. They are essential for future-focused investing. These ratios use predictions about a company's future performance to give us a better idea of what a stock is really worth based on its potential. Think of it like this. If you knew a company's earnings were going to double next year, wouldn't you be willing to pay more for its stock today? Of course you would. It's all about foresight. And that's the power of forward-looking ratios. They provide us with insights that can lead to smarter investments. They help us see the potential that others might be missing, giving us a competitive edge. So, buckle up, because we're about to dive into the world of forward-looking ratios and discover how they can help you make smarter investment decisions. It's going to be an enlightening experience. Get ready to see the future of your portfolio. Let's unlock the secrets of forward-looking ratios together. Let's be clear. Using only historical data to value a company is like trying to predict the weather by looking at old calendars. It's an outdated method that doesn't account for the dynamic nature of the market. Sure, you might get lucky sometimes, but it's not a reliable strategy. Relying on luck is not a sustainable way to build wealth or make informed investment decisions. The past is history. We need to focus on the future. The future holds the key to potential growth and opportunities that historical data simply cannot reveal. Traditional ratios, like the trailing PE ratio, tell us how much investors are willing to pay for every dollar of a company's past earnings. This can be useful, but it's only part of the picture. But what if the company is about to experience explosive growth? This is where forward-looking analysis becomes crucial. Or what if it's about to hit a rough patch? Anticipating these changes can make all the difference in your investment strategy. The trailing PE ratio won't tell us that. It's limited to what has already happened, not what's coming. That's where forward-looking ratios come in. They provide a more comprehensive view by incorporating future projections. They use estimates of a company's future earnings, sales, or other financial metrics to give us a more accurate picture of its value. This forward-thinking approach can help investors make more informed decisions. It's like having a sneak peek at the company's financial statements before they're even released. This insight can be incredibly valuable. Imagine two companies, both with a trailing PE ratio of 20. On the surface, they might seem similar. One is a mature company in a slow-growing industry. Its growth potential is limited. The other is a young, innovative company in a rapidly expanding market. Its potential for growth is much higher. Which one would you rather invest in? The choice becomes clearer when you consider future potential. The answer is obvious, right? Forward-looking analysis helps you see beyond the surface. But the trailing PE ratio wouldn't tell you the difference between these two companies. It's a limited view. Forward-looking ratios, on the other hand, would reveal the growth potential of the younger company, making it clear which one is the better investment. This approach provides a more nuanced understanding. So, ditch the rearview mirror and embrace the power of forward-looking ratios. It's time to look ahead and prepare for what's coming. Your portfolio will thank you for it. By focusing on future potential, you can achieve greater success and growth. One of the most popular forward-looking ratios is the forward PE ratio. This ratio is a key metric used by investors to gauge the future profitability of a company. It's calculated by dividing the current stock price by the company's estimated earnings per share, EPS, for the next fiscal year. This calculation provides a snapshot of what investors are willing to pay today for a dollar of future earnings. Let's say a company's stock is currently trading at $50 per share, and analysts expect it to earn $5 per share next year. This expectation is based on various factors including market trends, company performance, and economic conditions. The forward PE ratio would be 10, $50 divided by $5. This means that the stock is valued at 10 times its expected earnings. This means that investors are willing to pay $10 for every $1 of earnings the company is expected to generate next year. This willingness reflects their confidence in the company's future growth and profitability. Now let's compare this to the trailing PE ratio. The trailing PE ratio is based on the company's past earnings, providing a historical perspective. If the same company earned $4 per share last year, its trailing PE ratio would be 12.5, $50 divided by $4. See the difference? The trailing PE ratio is higher because it reflects past performance. The forward PE ratio is lower because it's factoring in the company's expected earnings growth. This growth is anticipated based on the company's strategic plans, market conditions, and other economic indicators. A lower forward PE ratio compared to the trailing PE ratio suggests that the market expects the company's earnings to grow. This expectation can drive investor confidence and influence stock prices. Conversely, a higher forward PE ratio might indicate that the market is skeptical about the company's future prospects. This skepticism could be due to various factors such as market volatility, competitive pressures, or economic downturns. But remember, the forward PE ratio is only as good as the earnings estimates it's based on. These estimates can vary widely depending on the source and the assumptions used. That's why it's crucial to use reliable sources for your earnings data and to understand the assumptions behind the estimates. Doing so will help you make more informed investment decisions and better assess the potential risks and rewards.